Buy the dip or cut our losses? Is this going to be an elastic bouncing ball or falling knife? So Smurf trading back again. For those watching this live from this Zoom Telegram group, welcome. For those watching the replay via this YouTube, right? The Telegram group link is in my YouTube description. Join so that you won't miss out any urgent updates in future. So I believe this stream, right, will change the way how you look at markets, the charts, as well as the general market consensus. What is your view of it? Instead of getting tricked by what the media is trying to tell you, this stream, right, will give you a new perspective in the current market context. So don't listen to what I say per se. Always listen with an investigative mind. Verify it by yourself. Verify and internalize it by yourself later, so that you will improve better in terms of how you trade and how you invest going forward. So without further ado, for those watching my YouTube, please help me slap the like button and subscribe if you are watching from the replay. So both SPX and Nasdaq have retraced 5% and 7.5% respectively from the all-time high. So you notice from SPX, you retraced like 5%, as well as Nasdaq retraced somewhat, quite significantly, right? Nasdaq retraced slightly more because it consists more of the tech stock that are overpriced for some of them. So now the thing is it time to panic and cut your losses? Or is it time to buy in more? So in this stream, right, I will go through 4 main things, right? Just 4 main things. Number 1, the causes of this retracement, right? Would it be a pressing concern, or would it be just another non-event like the Evergrande crisis that we spoke about like 1 or 2 months ago, right? Number 2, number 1 is the causes of this retracement. Number 2 is this going to be a pressing concern, or is it a non-event? Number 3 will be, what's our right course of action for the general market? Are we going to hold on? Are we going to relinquish our position, or are we going to add on more position? And last but not least, I will talk about Alibaba Status. So credits to Dalio as well as Adam Khoo for this video content as well as the idea. Okay, so first, what are the causes of this market retracement and what are the catalysts? So one of the main catalysts will be this Omicron variant, right? Look at this Wikipedia, it's more about talking about this variant that's first reported by the WHO from South Africa on 24th of November 2021, right? To cut to the chase, I'm not a doctor. However, my feel is this Omicron virus is going to be a non-event. In fact, it could be a blessing in disguise. This Omicron virus, right, if you research deep enough and read more into it, right, you realize that it's approximately like 20 times more infectious than the Delta variant. So Omicron could now become the dominant strain that overtakes the Delta variant. You know about infectious, right? How contagious it is, right? The thing about viruses is that the more infectious they are, the less deadly, the less lethal they are most of the time. This is how nature works. So you look at the past viruses, be it Ebola, polio, smallpox, dengue fever, chickenpox, you notice something. As long as it's very infectious, right? Let me just draw here so that you guys will understand what I meant. As long as it is very infectious, this scale, right? The X scale is talking about how infectious it is. As long as it's more towards this side, it's going to be very infectious. If it's more towards this side, it's very fatal. So what you see here, right? Those very infectious, like the whooping cough, the measles, the malaria, all this, right? They are very infectious. But you notice something? The deadliness, they belongs to the lower scale. Nature always works this way. What about the less infectious, like HIV and stuff like that? They belongs to the quite infectious, but not that contagious. In terms of the scale of being spread, right? It belongs to the 1 to 5 magnitude, right? As compared to those like whooping cough, mouse, measles, all this belongs to the 12 to 17 magnitude. Notice those are more towards the case of fatality rate. So then again, this is how nature works, but I have no crystal ball. Only once WHO give an official release or report, then we can confirm of my hypothesis. Is this going to hold true in terms of this could be a turning point in terms of the whole COVID-19 cases? The next point that I want to talk about is about the change in monetary policy. That could be the main reason that we should be more concerned about. All right, the change in monetary policy. You know, all along, right, the Fed have been printing money like no tomorrow and keeping interest rate low. In fact, right, previously they mentioned that they will keep the interest rate at zero for at least like 2 years plus or so. And even when the interest rate the inflation rate increased to like 5%, Jerome Powell actually steps in and assure the public that this is going to be transitory. So this transitory description, right, has more or less become his trademark stance. So like, don't worry, this is going to be transitory and stuff like that. Therefore, this creates a lot of easy money that is getting pumped into the market with a lot of circulation on this money, right? Liquidity that is being pumped into equity, both for the profitable and non-profitable or overpriced business, right? So those non-profitable or overpriced business include those in the ARK ETF stocks like Roku, Teladoc, Zoom, etc. So you notice some of the ARK ETFs like Roku, Teladoc, Zoom, all these businesses, right, got benefited by this pump in money. But you must bear in mind of something. All these businesses are actually super overpriced. All right, super overpriced. I'll get back to this next. Okay. Now the thing is, recently, right, Jerome Powell actually changed his stance, right, from transitory inflation to not coming down anytime inflation. He changed his stance all the way. It's a big flip. He said that interest rate will still be kept low, but they will begin to taper and stop printing money by March and April next year. So technically, we have only like 4 or 5 months before they stop printing money and start tapering, right? Like the buyback of the bonds and stuff like this. This has freaked out many people. Like they'll be thinking like, no more money, the party is over. So that's the reason why when you look at S&P, there was a big retracement of 5%. But on the other hand, emerging tech stocks are collapsing. Like Zoom, look at Zoom. Zoom is zooming down. Look at this. S&P retraced only 5%, right? Zoom dropped 40%. 40%. What about the rest? DocuSign. Let's look at Roku. Roku dropped how much? Near 42%. So the point is, right, all these bubble stocks are bursting. Now the important question is, moving forward, is it a time to buy the dip? Yes, but we have to be very cautious. What? We have to be very cautious. We have to buy companies with positive free cash flows. So few examples, right, include like Microsoft, Meta, which is previously known as Facebook, Visa, MasterCard, Amazon. Just look at, as long as they are making money, they are good investment. Just look at some of the financial statements, the free cash flow, you understand what I meant. Like for Microsoft itself, right, if you look at the cash flow, the free cash flow, you notice that this has been a very healthy company, right? The free cash flow has been increasing year on year, right? Consistently. What about the case of, the next case we are talking about Meta, previously known as Facebook. So although there's a lot of bad negative news that's being highlighted by the media the past few months and quarter, right? You notice that Facebook, its free cash flow has also been increasing quite steadily all this while. So the point is, don't get affected by the media, but look at the source. Look at the actual intrinsic value, the inherent value of the stock to determine whether that stock is worth a purchase and worth to buy the dip, right? But on the other hand, if you look at other stocks like Dalio, right? Notice something? This company has been losing money, right? Yet companies like Art Invest has been investing heavily on them, and that's the reason why during a bubble burst, although SPX merely retraced like 5%, companies like Dalio retrace more than 40%. So that's a case of you have to be careful and buy stocks that are stable with a high intrinsic value. So in the times of retracement, you won't take such a big hit. Okay, so let's move on. So what are other factors, right? What are other factors that shows that an impending strong recovery is incoming? That is about this thing. The fact that Dalio point of view, right, says that during these turbulent times, it's also important to be safe and well-balanced portfolio. So he stood that cash, right, is not the place to be in, despite the volatility in the market triggered by this new COVID Omicron variant. So if you listen to his interview, right, he's more towards the case of don't hold much cash. Even this COVID Omicron variant, right, he's more towards you still have to invest in the market. All right. You should not be afraid to invest in the market in this case. And why should we listen to him? If you notice something, right, Dalio is one of the most renowned and accurate hedge fund manager in the whole world, right? The reason why he came into so much prominence, right, is back then in 2008, when the whole world is kind of like indifferent about what is going to happen next, right? You notice something? His funds, right? His hedge fund, right, begin sounding alarms in the spring of 2007 about the danger of excessive financial leverage, right? They even tried to tell met up with the US Treasury Department of Staff and other White House economic advisors in December. And these findings were disclosed, but were largely ignored. So they have so much vision about what is going to happen, and based on the mere like 30 years of experience in the market, right? I would say their point of view will hold a lot of weight in terms of determining what is the right course of action going forward. This is point number one. What about point number two? The point number two is, why I think there will be a strong impending recovery is based on P, right? Technicals. If you just look at the technicals per se and not be biased of what exactly is going to happen next, you'll notice that the S&P technical clearly shows a potential reversal inflection zone. Notice something, when the price go up, it's always in a wave pattern. But how we know this could potentially be going up, right? We have to look at certain technicals. The first technical would be the swing high, technically will be a support. Previous resistance will turn support most of the time. That's how market works. If you notice the previous like breakout area like this area, become a swing, become a support, then when you break out from the previous resistance, it will turn support. Break out from the previous like swing high low will become another support. That's one technical. The second thing is about the moving averages. The 50 and the 100 SMA, right, always serve as an important inflection zone for the market. Over the past few months and even years, this proved to be true. Market retrace, bounce is always the case, right? It is always the case. Now we have reached where? The 50 SMA as well as the 100 SMA. And this point potentially could be the next inflection zone. So this is about the technical. There are three main points. Previous resistance turn support, point number one, the 50 and 100 SMA that are adding value to the technical analysis. All right, so we have just discussed about technical analysis. What about the next point? If you notice our next point, right, I will be talking about the fear and greed index, right? The market fear and greed index currently is an extreme fear at this juncture. You know, thoughtful observer would have known that fear and greed, the fear and greed index, right, is like a pendulum, right? It's a pendulum. It will always swing between extreme fear, right, and extreme greed level. Based on history, we have reached a potential reversal zone. Just investigate it by yourself. You look at how the fear and index reacts, right? You notice something. It's like a pendulum. It goes down, it goes up. During the crash, it goes down, it goes up. And all this while, the 20 level has served as a strong inflection zone for price to go up. And where are we today? Where are we today? It doesn't take a genius for us to know what is the highest possible case. Is there a chance that it will go down lower? Yes. There's a chance it go down all the way to zero. But if history were to repeat itself, and based on all the points that I pointed out so far, the highest probable case, right, is not that difficult to know. We have to make decisions based on facts, the math, the repeated patterns, and the overall fundamentals of how, based on chance, where we're going to head to. This is only point number 3. What about the point number 4? Okay, point number 4 perhaps is going to be the most important point. It's the phenomenon of the current bond market. For the benefit of those who don't quite understand about what bond market is, right, and how it relates back to the price prediction, let me explain in a nutshell. Okay, let me explain in a nutshell. The bond market is what is the biggest market in the whole world. In case you don't know, it amounts to around $110 trillion US dollar worldwide combination. That's the market cap of this bond market. It's so huge. And equity market is the second biggest market. It approximates to, as of date, near 100 trillion worldwide. Then you must be asking me, how does this relate to our analysis? You must understand something. The money flow always flow between either to the bond market or the equity market. It's always between these two areas. We are not talking about the real estate market and stuff like that. We're talking about these two major big markets for us to have a highest assurance of where the money is going to flow to, as well as what is our prediction next. So with that in mind, how to know it is a good time to buy the dip? For this, right, we'll look at the historical data and draw findings from it. So looking at the historical data of market crash since 1950s, right, you notice something. All this market crash, for the past 7 market crash from the Black Monday, right, the Gulf War, the dot-com bubble burst, the global financial crisis of this subprime mortgage, the US credit downgrade, the China trade war in 2018, as well as the coronavirus in 2020. All these, right, have already shown signs. Before all this happened, right, the bond market information have shown signs and symptoms that will happen. It's just that most people turn a blind eye, right? Let me explain how. If you go to the bond market itself, right, you notice that the current yield is, the 10 yield is 1.44%. It's a decrease from the previous yield of like 1.66%. We are talking about the 10-year treasury yield. So as I explained, right, as long as the yield is higher, right, the money tends to shift from the equity market to the bond market. If it's lower, the money from the bond market tend to shift over to the equity market. It's always the case. That's only one part of it. But for me to explain about how significant it is, right, we have to look at the inverted yield curve. Inverted yield curve, right? The inverted yield curve. What do we mean by inverted yield curve? Is this. Inverted yield curve reflect a scenario where the short-term debt instruments, right, have a higher yield than the long-term instruments of the same credit risk profile. So this inverted yield curve is a strong indicator of an impending recession. All right. The reliability of this yield inversion is a leading indicator. It's a leading indicator, just bear this in mind. So for you to understand this, look at this. I think at this point of judgment, what is better to show the example for you to understand? So if you look at back in the dot-com bubble burst, okay? Inverted yield is when the short-term, you can see the short-term yield over here. You can see? This is easier for you to see. So all these x-axis, right, is saying that the short-term, the more towards the right side belongs to the longer term. So as long as this short-term yield, right, gets higher as compared to this long-term yield, it means it's going to be an impending market crash. That's how the past several recessions was telling us. If history were to repeat itself based on natural workings of the society, this is going to be a very important indicator. All right. This is going to be a very important indicator. But you must be asking me, why is that so? So in a nutshell, for me to explain in a layman terms, for all of you guys who don't understand why is that so, just imagine this. The bond market, right, is a big group of geniuses, right? Those huge fixed income portfolio manager with some kind of crystal ball. They understand that they always make very accurate prediction. So far, they have pretty much accurate. So imagine if you are them, right? You know the market is going to crash and you have like $1 billion, right? You have $1 billion. Would you want to lock up that $1 billion in this kind of like 1 month, 3 months, you know the market is going to crash? Obviously, you won't, because you want to have more spare cash so that you can go into the market when the market crash, right? So that you have available of large cash for you to transfer them into the equity in the event the market crash. So that's the reason why when they see that there's a chance the market going to crash, right? The market tends to have like larger treasury yield, short-term treasury yield to entice investors, entice those bond market people, right? Come lock in your money, please. Lock in. That's why they have to increase, because they want to lock in the money, right? But because of demand and supply, they say, no, I'm not going to lock in my money because I know market is going to crash. So just picture them to be like profit, or because so far they have been very accurate for the past 7 recession. So with that in mind, right, as long as this is higher than this, you have to be careful. So let's look at the past history. If you look at the play button, notice something? Notice something? This is a point of time, right? This is the point of time .com bubble burst. .com bubble burst. What is this? Short-term yield is higher, overall sloping down. Inverted yield curve. What happened next? .com bubble burst. I think I cannot use this color because this color is not that. What about red color? .com bubble burst. You think this is coincidental? Look at the next one. As long as it's, okay, another thing to note is, as long as the yield is pointing outwards, right, it's safe because it's normal. All these geniuses, right, perceive that market will continue to climb. So let's park some kind of his treasury. It's not going to collapse anytime soon, right? So as long as you can see the treasury yield to be normal, right, which is not inverted, there's a high chance, high assurance to say that the market will continue to rally up, right? Will continue to rally up. So this is effectively what they are trying to say. So let's go on. Let's go on. Get ready. Get ready. You guys notice something? For the past few months, right, you notice that there's some kind of declining already. There's already some few months that actually there have been short term. There's a warning sign already, right? There's a warning sign. So after that warning sign, right, the slight warning sign that those short-term bonds, right, I think, let me just repeat here so that you guys can see clearer. I think here is better. Let's go here. This is more or less flat. Look at this. All this is more or less flat and more towards inclined towards the sideway when previously it was so much of a inclined slope going up, right? It's an impending crash as well. And you notice something? The market, as expected, that was near the peak before the crash in 2008, the Lehman Brothers crash. Before the Lehman Brothers crash. Let's move on. So my point is, as long as, right, I think I have gone through a few examples already. My point is, what is the current status right now? What is the current status right now? The current status is at such an extreme case of non-inversion. There's no case of that warrant a kind of like potential crash or whatsoever, because the short-term yield is in fact lesser than the long-term yield. If history were to repeat itself, there's no sign of a potential crash incoming. So that's the point number 4, the phenomenon of the bond market. In fact, right, this is only one part of the inverted yield. Let's talk about the second part. And this part is something that you guys should pay attention to. Okay? And this part is about talking about, right? Talking about the bond price is still increasing. The bond price is still increasing. So if you look at the TLT, TLT is in fact the 20 plus years treasury bond price. You notice for the past few weeks, right? The past few weeks, the bond price has been increasing. And the thing about bond price increasing, right, normally is an indication that the market, the flow of money, right, tends to be still going towards the equity side because the bond price is expensive. Let's just look at some example. Okay, you notice a strong increase in bond price, right? Strong increase in bond price around the February period, February 2020 period, all the way, during the crash all the way, effectively increase in bond price. And what happened was, if you compare to the SPX, right, that was in fact the time whereby market begins to strongly rally back up because the bond price is increasing significantly. What about other example? Still remember back in the case of the Lehman Brothers case, market is the market is crashing down and no one knows where's the recovery. And suddenly, right, the bond price went up significantly. As you can see from the end December 2000 the end of 2018 period, the bond price increased significantly. The money flows to the equity. And that is when the strong recovery happened as well. The orange line represents the SPX price. So my point is, as long as bond price is increasing, which is more or less a leading indicator, we are more or less near towards the strong market recovery phase. This is something that we should not underestimate. Okay, so in terms of, there's 2 points. In terms of 2 points of this bond market, the first is the inversion. There's no inversion in the yield rate. There's no inversion of the yield rate. There's no inversion. And the second point is the bond price is increasing. With these 2 factors itself, we have a high assurance to say that market recovery is still intact. All right, there's high assurance of that. So, my conclusion. What is my conclusion? Let me just look at certain parts so that I can show more details. What are the causes of this retracement? The Omicron virus, the change in monetary policy. Are these pressing concern or non-event? No. In fact, factors are pointing towards a strong market recovery based on, number 1, Dalio point of view. Number 2, the S&P technicals. Number 3, the market fear and greed index, which is still at the extreme fear index. And number 4, which is the most important factors out of all, the phenomenon of the current bond market, which consists of 2 points. All right, 2 points. The no inverted case of this bond yield, as well as the increasing bond prices. These 2 points itself prove to us that there's a pointing towards a strong market recovery. Okay. So what is our right course of action for the general market? I believe a strong rebounding is incoming, but it does not mean that we will just buy any stock blindly. Ultimately, we have to buy stocks that are profitable with good business model, and we have to avoid those overhyped stock, right? We have to overhyped stock. That's the main point of this. Okay, and let's talk about, so far we've gone through everything. Now the last part is we have to talk about Alibaba Status. By the way, this stream only lasts 10 minutes left, so I'm going to be fast and talk about Alibaba Status in 10 minutes. The thing about Alibaba, right, is very interesting. Okay. By the way, I have increased the Alibaba is like free falling to the case of people are freaking out. Why is it so? Am I wrong and stuff like that? On 30th November, I bought Alibaba at $128, with bringing the total invested percentage to 20%, right? So I believe that price was near the bottom, and it wasn't. So the question is, Was I wrong in this stock? Let's dive in. There is yes and no. In terms of business model, no, I was not wrong in this stock. It is still a great business that is still growing, right? So far, I've been talking about the last update of Alibaba. I talked about this iron triangle of Alibaba, right? It's still intact, and that the China government is happy to have Alibaba because of the fact that the China consumer business, right, will facilitate like 1.5 trillion of annual consumption. One person consumption is another seller income. So it's their incentive to have Alibaba survive. It's more like just thinking of a stern father that want to kind of discipline his child. He want his child to grow. They do not want to kill his child. And we also talk about this core business of this cloud computing, all these are intact, right? But the thing is, the media, right? Recently, the earnings came out and the media spin the information so negatively and paint it in a very negative light that say it was terrible. So this is something that I will go through in details later on. So I say in terms of whether I'm right or wrong, I say yes and no, right? In terms of stock business model, no, I'm not wrong. But in terms of bottom of the stock, yes, I was wrong in the price bottoming, all right? I was wrong in the price being at the right bottom. Because if you look at Alibaba, let's see over here. That's 9988. Let's remove this because this is kind of like, I bought Alibaba in 1288 and it continued to rally back, fall down sharply over the next few days. But the case is, you must know, you have to understand something. Being a professional trader, right? You can't be right 100% of the time. You can't be right 100% of the time for the short-term market. We don't hold a crystal ball, all right? We don't hold a crystal ball. We use math, patterns, TA, fundamentals to ascertain the most probable outcome, all right? We are right sometimes and we are wrong sometimes. The point is that when you make a decision to buy or sell, it is based on a calculated risk, right? Hits we win, tails we don't lose much. That's the point of being a professional trader. Unfortunately, we are wrong this time for short term. The question would be, what do you do now as an investor? Now again, investing and trading is very different. If you are trading Alibaba with leverage, you should have cut loss long ago, right? But in trading, once you hit, that's why I say, in trading, once you hit a stop loss, you must get out. However, for investing, right, should you hold on? For investing, the decision to buy or sell has nothing to do with short-term price movement. It has to do with the underlying business. If the business model is great and growing, it doesn't make sense to sell. In fact, you don't have to have a full position. If you don't have a full position, you should add on at the right time. In my opinion, this business is great. There's nothing to worry about it. So let's look at the recent earnings report and discuss. Look at this. Revenue increased by 29%. Revenue increased by 29%. So in context, right, if you look at its closest cousin, which is Amazon, look at Amazon, it merely increased by 15% relatively, right? So let me ask you this, a company growing at 29%, isn't this a great company? Despite the regulation, the fines, the China economy slowing down, the Evergrande property crisis, Alibaba is still growing. The net income, 4.4 billion. You must be saying, it's down 39%. Come on, it's not a good business. Take a step back. Yes, it dropped, but it's still making money. Not like Neo or Plantier or those kind of losing monies. And in fact, the reason why it decreased so much is because 1.6 billion is into investment in key strategic areas such as Taobao deals, local consumer services, community marketplaces, and Lazada. And all this investment into all this area, right, is for future growth. Future growth. In fact, if you adjust it back, right, the net income, adjusted income is actually 6 billion, which is unchanged from the year on year. Okay, so the thing about Alibaba, Amazon actually share similar business model. For those of you recall, in the last many quarters back, Amazon did the same thing. They had very disappointing profits and the Amazon stock collapsed, right? Amazon also spent heavily on investment because they are not focused on short-term profit gain. They are more focused on long-term. And know what? Amazon price today increased insanely. Alibaba today is what Amazon did before that. Just like that. It's the same thing. Another point to note is, in terms of Alibaba revenue segment, right, the core commerce as well as the cloud computing, right, the cloud computing is still unprofitable. You must understand this, right? Alibaba considered this business in its infancy. It only accounts like 0.1% of the whole China GDP, significantly lower than US, implying that there's tremendous growth. So being in this infancy stage, right, it's understandable that those cloud computing that will have huge inertia at the stage, right, at a big scale. So you must know that this cloud computing segment will boost Alibaba earnings in the unprecedented, in the unforeseen scale in the future. By the way, Alibaba core commerce business, right? Amazon core commerce businesses, right, is not that profitable. Amazon is so profitable, most of its revenue is derived by their cloud computing. So picture this, for Alibaba, even without the cloud being profitable, Alibaba is already making so much profits. So when their cloud business begins to be very profitable, just imagine how much more revenue they will get. And what is more encouraging is that the overseas international users outside of China, right, is growing faster than the Chinese users. And this is very important because this means Alibaba is less and less reliant on China. The potential for growth in their ecosystem internationally is a lot bigger than locally. And you must be asking me, since Alibaba is so good, right, why is the stock still collapsing? You must know something. In short term, stock price is not business, right? Stock price is not business. As what Peter Lawrence say, right, often there's no correlation between the success of a company operation and the success of stock over a few months. In the long term, there is 100% correlation between the success of the company and the success of stock. Short term will be less than a few years. Long term, we're talking about a horizon of 2 years and more. So that's the reason why we have a strong commission in Alibaba. So today, our accumulative profit is just 400%. But I believe we have a longer holding horizon, right? That's how you get back on track. So guys, we have to be a reasonable